EPK Capital presents Daily Brief, 26 August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host, Alan. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. The trading session of August 25, 2025 unfolded as a tale of two markets, defined by a stark divergence in sentiment across global financial centers. The initial optimism sparked by a dovish signal from the US Federal Reserve was met with a wave of caution as the new week began. Asian markets, having their first opportunity to react, surged ahead, playing catch-up to the rally that had lifted Wall Street on the previous Friday. This enthusiasm was ignited by Federal Reserve Chair Jerome Powell's pivotal speech at the Jackson Hole Economic Symposium, where he hinted at the possibility of forthcoming interest rate cuts. However, this bullish momentum failed to fully translate to Western markets. European indices ended the day broadly in negative territory, while US markets delivered a mixed and hesitant performance. Investors appeared to be re-evaluating the nuances of Powell's message, weighing the prospect of monetary easing against the underlying economic weakness that necessitates it, all while navigating a fresh set of geopolitical and corporate headwinds. The day's trading action underscored a market at a crossroads, caught between the promise of central bank support and the reality of persistent economic and political risks. Wall Street's reality check. A day of divergence. The US trading session was a study in contradiction as the major indices painted a fragmented picture of investor sentiment. The Dow Jones Industrial Average retreated, closing at 45,416.99, a decline of 214.75 points, or 0.47%. The broader S&P 500 hovered near the flatline, ending the day at 6,466.09, down a marginal 0.82 points. In stark contrast, the technology-centric Nasdaq 100 index continued its upward trajectory, gaining 53.51 points, or 0.23%, to close at 23,551.63. This split performance revealed a sophisticated rotation beneath the surface, as investors digested the full implications of the Federal Reserve's potential policy shift. The market is currently navigating a complex dynamic where positive news for financial assets is directly linked to negative news for the real economy. The Nasdaq, heavily weighted with long-duration growth stocks whose valuations are highly sensitive to interest rates, outperformed. Fed Chair Powell's speech explicitly connected the possibility of rate cuts to a softening labor market and downside risk to unemployment. Investors in the technology sector appeared to focus on the solution: lower borrowing costs, which increase the present value of future earnings. Conversely, the Dow, composed of more cyclical and industrial companies whose fortunes are tied to the broader economic cycle, underperformed. Investors in these names seemed to focus on the problem: a slowing economy that could directly harm current revenues and profits. This divergence signals a market that is becoming more discerning, favoring companies with growth narratives perceived as less dependent on the overall economic cycle. Sector performance and key movers. The day's trading activity highlighted this clear rotation. Defensive sectors such as healthcare and consumer staples lagged, while technology and growth-oriented stocks demonstrated resilience. The Nasdaq's strength was propelled by significant gains in several tech behemoths, including Nvidia, which rose 2.06%, Alphabet, which climbed 2.20%, and Tesla, which added 1.59%. 10. On the other hand, the Dow was weighed down by notable losses in healthcare giant Merck & Co., which fell 2.42%, and consumer staples mainstays like Procter & Gamble, 1.56%, and Coca-Cola, 1.23%. Several corporate stories captured the market's attention and drove significant price action. Keurig Dr. Pepper, KDP. The beverage company was one of the day's biggest losers across the market, with its stock plummeting 11.3%. The sharp decline followed the announcement of its approximately $18 billion deal to acquire JDE Peet's, the Dutch parent of Peet's Coffee. The market's harsh reaction signaled deep investor skepticism regarding the acquisition's valuation and the subsequent plan to split the combined entity into two separate US-traded companies. Intel, INTC. Shares of the semiconductor firm experienced a volatile session. After surging on Friday following news that the US government would take a 10% stake in the company through CHIPS Act funding, the stock initially rose on Monday before reversing course to close down 1%. President Donald Trump had publicly lauded the agreement as a great deal for America. The reversal in the stock's trajectory suggests that initial enthusiasm has given way to a more sober assessment of the long-term implications of government involvement and whether it can fundamentally alter Intel's competitive landscape. Furniture stocks under pressure. Political rhetoric translated directly into market losses for the furniture sector. Shares of retailers like RH, Wayfair, W, and Williams-Sonoma, WSM, fell sharply in pre-market and regular trading. The sell-off was a direct response to a social media post from President Trump announcing a major tariff investigation on furniture coming into the United States. This event demonstrates that in the current climate, political headline risk can act as a powerful, sector-specific catalyst capable of overriding broader market sentiment and forcing investors to price in a higher risk premium for import-dependent industries. The macro-political epicenter, decoding the Fed and the White House. The market's trajectory is currently being dictated by two powerful and often conflicting forces: monetary policy from the Federal Reserve and trade policy from the White House. The events of August 25th were a direct reflection of investors attempting to navigate the signals emanating from both. Dissecting Powell's dovish pivot. At the annual Jackson Hole Symposium, Federal Reserve Chair Jerome Powell delivered a speech that shifted market expectations. The pivotal phrase that shifting risks may warrant adjusting policy was interpreted by traders as a clear signal that an interest rate cut could be on the table for the Fed's September meeting. This interpretation was swift and decisive. Market-implied odds for a September cut, as measured by the CME FedWatch tool, surged to 90%, up from 75% earlier in the week. This dovish tilt sent a wave of optimism through risk assets on Friday, setting the stage for Monday's global trading. However, a closer reading of Powell's remarks reveals a more nuanced position. He was careful to balance his dovish leanings with a hawkish caveat, reiterating that inflation remains a significant concern, especially given the price pressures stemming from US tariffs. This internal conflict at the Fed was also evident in the minutes from the July FOMC meeting, which were released the previous week and struck a more hawkish tone, suggesting a division among policymakers on the path forward. This underlying tension helps explain the market's more muted and cautious tone on Monday, as the initial euphoria gave way to the realization that the magnitude and timing of future rate cuts are far from guaranteed. Trump's dual-pronged influence. Simultaneously, the White House continues to exert its influence on markets through both direct pressure on the Federal Reserve and the strategic use of trade policy. 1. Pressure on the Fed. President Trump has maintained his public campaign aimed at influencing the central bank's decisions. Recent actions include targeting Fed Governor Lisa Cook and publicly calling for her resignation, a move that has drawn concern from international observers. European Central Bank President Christine Lagarde warned that any efforts to undermine central bank independence could unleash instability in the global financial system. 2. Tariff threats. The administration is also actively using trade policy as a tool. The new investigation into furniture imports and the looming August 27 deadline for additional 25% tariffs on certain Indian goods are creating tangible uncertainty for specific sectors and the broader economy. This is not just a theoretical risk. Recent PMI data from S&P Global indicated that existing tariffs were already a key factor in pushing up average selling prices at the fastest rate in 3 years. The Federal Reserve is thus caught in a difficult position, squeezed between political pressure for rate cuts and economic data showing persistent, tariff-induced inflation. By signaling a potential cut, Chair Powell appears to be prioritizing the central bank's employment mandate over its price stability mandate, perhaps viewing the inflation as transitory or yielding to the intense political climate. This sets up a high-stakes scenario for the week ahead. The upcoming economic calendar is packed with data that will either vindicate or challenge the Fed's new stance. The most critical releases will be the July Personal Consumption Expenditures, PCE, price index, the Fed's preferred inflation gauge, and the second estimate of second quarter GDP. A hot inflation reading could place the Fed's credibility on the line, forcing a difficult choice between fighting inflation and supporting a softening labor market. Trading across the time zones. The divergence in market sentiment was most pronounced when viewed across different time zones. While US markets hesitated, European and Asian markets had distinctly different sessions, shaped by local factors and the timing of their reaction to global news. Europe, in the red European equities, failed to carry forward the positive momentum from Wall Street's Friday session. The Pan-European Stoxx 600 index closed down 0.4%, Germany's DAX fell 0.4%, and France's CAC 40 slid 1.6%. The market in the United Kingdom was closed for a public holiday. A significant driver of the negative sentiment was a precipitous 18% plunge in the shares of Danish renewable energy giant Ørsted. The sell-off was triggered by news that US authorities had ordered the company to halt work on a major offshore wind project off the coast of Rhode Island. This single piece of corporate news cast a pall over the entire renewable energy sector and contributed to the broader market decline. The downturn in European shares occurred despite the release of a better-than-expected German IFO Business Climate Index, which showed sentiment rising for the 8th consecutive month. This suggests that the negative, company-specific news from Ørsted, combined with a broader reassessment of the Fed's message, was powerful enough to overshadow positive local economic data. Asia's bullish catch-up. In sharp contrast, Asian markets posted robust gains as they opened for the week, offering the first regional reaction to Chair Powell's dovish speech. Hong Kong. The Hang Seng Index was a standout performer, surging 1.94% to close at 25,929.91. The rally was broad-based, with technology giants leading the way. Tencent Holdings gained 2.42%, and Hong Kong exchanges and clearing rose 3.30%. Market sentiment was also bolstered by persistent hopes for additional economic stimulus measures from Beijing. Japan. In Tokyo, the Nikkei 225 index advanced, closing up 0.41% at 42,807.82. India. Indian equities participated in the regional rally. The BSE Sensex gained 0.40% to finish at 81,635.91, while the Nifty 50 index rose 0.39% to 24,967.75. The advance was decisively led by the information technology sector, whose companies are highly sensitive to US economic sentiment and interest rate expectations. Top software exporters, Infosys and Tata Consultancy Services, TCS, were among the leading gainers on the Nifty 50, climbing 3.8% and 2.88% respectively. The starkly different performance between Asian and Western markets highlights a sentiment lag. Asian markets on Monday were reacting positively to Friday's news from the US. By the time European and US markets opened, they had already priced in that news and were moving on to the next set of concerns, including upcoming economic data and fresh political risks. This demonstrates that global markets, while interconnected, are not perfectly synchronized, and the cautious tone in the West could serve as a leading indicator for how Asian markets might trade in the subsequent session. Crypto's wild ride, all-time highs and whale dumps. The cryptocurrency market experienced a period of extreme volatility, characterized by a euphoric record-breaking rally, followed by a sudden and sharp reversal. Ethereum's record and reversal, ETH, was the day's main event, surging to a new all-time high of $4,953.73 on Monday. This powerful rally was largely attributed to the same macroeconomic driver, lifting risk assets globally. Optimism that a potential Fed rate cut would inject more liquidity into the financial system and increase investor appetite for speculative assets. However, the celebration was fleeting. After hitting its peak, Ethereum's price reversed sharply. By the end of the day, the token was trading down approximately 4% to 6% from its record high, erasing a significant portion of its earlier gains. The Bitcoin whale event. The catalyst for the market-wide downturn appeared to be a massive sell order from a single large Bitcoin BTC holder, colloquially known as a whale. On-chain data watchers observed this entity liquidating a substantial balance of 24,000 BTC, an action that sent a shockwave through the market and triggered a cascade of selling. In the wake of this event, Bitcoin's price, which had rallied to over $117,000 following Powell's speech, tumbled to below $112,000. The fallout from this sell-off was widespread. Bitcoin's price broke below its 50-day moving average, a technical level watched by traders that is often seen as a bearish signal. The negative sentiment spilled over into crypto-related equities, with shares of companies like Coinbase, Coin, and MicroStrategy, MSTR, also declining. The overall market mood cooled, as reflected by the Crypto Fear and Greed Index, which fell to a neutral reading of 47. This recent price action highlights an evolving dynamic within the cryptocurrency ecosystem. Bitcoin's volatility has been gradually decreasing, leading it to behave more like a traditional macro asset, while speculative capital seeking higher returns and volatility has increasingly turned to Ethereum and other altcoins. A new market structure appears to be forming, where Bitcoin acts as the digital gold anchor for the ecosystem, attracting institutional and long-term capital. Meanwhile, Ethereum serves as the high beta, risk-on instrument. This implies that while capital may flow disproportionately into Ethereum during risk-on periods, systemic events in the Bitcoin market, such as a large whale sale, can still act as a gravitational force, pulling the entire crypto space down with it. The final word, navigating the week ahead. The trading session on August 25th served as a crucial inflection point. The initial euphoria that followed the Federal Reserve's dovish signal has been tempered by a more sober assessment of the underlying economic risks and emerging political threats. The divergence seen across asset classes, sectors, and geographic regions paints a picture of a market that is deeply uncertain and actively searching for its next major catalyst. As investors look to the remainder of the week, two key events are poised to provide clarity and potentially set the market's direction. 1. US inflation data, PCE. The release of the Personal Consumption Expenditures Price Index on Friday stands as the most important economic data point of the week. This report will be scrutinized for any signs of persistent inflationary pressure. A cooler than expected reading would likely give the Fed the green light to proceed with a rate cut in September, potentially fueling another leg up in risk assets. Conversely, a hot inflation number would put the Fed in an exceptionally difficult position, forcing it to choose between its dual mandates and creating the potential for significant market volatility. 2. NVIDIA, NVDA. Earnings. Scheduled for release. After the market closes on Wednesday, NVIDIA's quarterly earnings report has transcended a single stock event to become a referendum on the entire AI-driven market rally. Given NVIDIA's significant weighting in the major indices, its results and, more importantly, its forward guidance will be critical. Investors will be intensely focused on the company's commentary regarding profit margins, demand from data center clients, and the outlook for sales in China. This report has the potential to either reaffirm the bullish narrative that has propelled the tech sector or introduce a new wave of doubt that could challenge the market's leadership. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.